Hey, good day, guys. My name is Sunday. You are welcome to having forex. Yeah, I welcome you all to today's episode. How have we been doing these past days? It's been a week now, and I would like to know how my teachings, all the materials, has impacted us positively. I would like us to share ideas. Share with me your experiences so far as this journey is concerned. to be a to be a forex trader or to become a forex trader, it requires much work, commitment, have the zeal and consistency. You have to be consistent in order for you to make progress. You know, anything that is worth doing, it's it does not come cheap. You have to invest time, and you have to invest time, and you have to be consistent in achieving what you aim at. That is just it's part of life. If you are planning to achieve a particular thing, you need to put in more effort, towards achieving it. Yes, that being said, today I'm going to be teaching us different entry options when trading pin bars. Like I told us before, pin bars are a signals that come from the candlestick price action that let us know that there's a price rejection from a particular level. That means um, when when a change of character is about to occur, you see a rejection of price, be it downtrend or uptrend. If a current trend is going uptrend, and when you see a pin bar that signifies price rejection from a certain level, watch out for it because the next bar market might just be a reversal to the opposite direction. So today I'm going to be teaching us the different entry options, how you'll be able to use this pin bar to make an entry into the market or to execute your trade, to be in the trend or in the market. So we have the aggressive entry option. Aggressive entry option. This method is an option where you place your entry immediately after the pin bar closes without waiting for another confirmation. The word aggressive, by the time you just see a pin bar form, the anatomy, of that pin bar, of a pin bar is telling us a story that there is a rejection of price. For example, I will show us this. When you look at by my left hand side here, when you see there was a bullish trend. This one is a bullish trend. The price action was going bullish. At this point, it now turned, it started coming down. You understand? So when it retraces to this point, look at this one. It's supposed to start going back up trend, but immediately it got to this point, sellers rejected the price from here and pushed it back and closes at this point. Now, this is a clear pin bar. And where does this pin bar occur? At the support level. A support level that later became a resistance level because now the price, this is the trend. It was bullish. The trend was bullish, but it got here. Normally, if a trend is bullish, it will never go bullish forever. It will get to a point where there will be a retracement. I've taught us before, if you're just watching my video for the first time, go back and check my previous video where I explain what an impulsive move, a retracement move means. Once a price action is trending, this is an impulsive move. It got to this point, there has to be a corrective move, which is a retracement before another impulsive move. But when it now fails to pull up, because it got to this point, the buyers intended pushing this price up again, but sellers at this point rejected it. That is the reason why you see this pin bar. So that is how it is, guys. So the aggressive entry option, this method is an option where you place your entry immediately after the pin bar closes without waiting for a further confirmation, any other confirmation. You see the pin bar. Now there was a rejection. Immediately this pin bar closes, you place your entry. That is an aggressive entry option. We have people who will wait for another confirmation before they will enter. But you have those who choose to, use this strategy to get into the market immediately without wasting time. By the time they see a pin bar, as soon as that pin bar closes, because the pin bar signifies a rejection of price. Now, as soon as the pin bar closes, they will just get into the market and place their trade. This entry strategy will enable you flow. This is the advantage of this entry strategy, this aggressive entry option, is that the entry strategy will enable you to flow with the trend from the very beginning, because sometimes the price goes higher after the close of the pin bar, and if your order is not placed quickly, you might miss the opportunity. So that is how it is here. As soon as the pin bar, as soon as there's a rejection and it closes like this, then immediately you place your entry. Then you flow with the trend. But there are people who will wait for more confirmation, more confluences, for them to be very, very sure before they get into the market. But the downside of it is that if you have to wait for more confluences or for a retracement to happen, sometimes it does not occur. The price will just go straight down, And what will not happen is that you will miss the opportunity, because by the time there is a strike and it start, going downward, if the price starts going bearish, aggressively, where to put your stop loss might be too long, so you won't be able to get into the trade, because you have to consider where to put your stop loss level before you get into the market. That is why you see people, as soon as the pin bar closes, they will just put their stop loss, because the stop loss will be very tight and minimal. Then they will just flow with the trend. So that is how it is, guys. So the downside of aggressive entry option, the downside of aggressive entry option in forex trading is that it may result in more false signals and high risk of loss, because at this point, when you see a price rejection, but instead of you to wait for more confirmation simply means that as you see the rejection, price will tend to go bearish a little bit, then it will now reverse. it will reverse because these buyers again will reject it and the price will start going bullish. So at that point, it will come back and hit your stop loss and take you out. But thank God we have what we call stop loss that will protect, your entry, that will protect, your asset. Act as a gatekeeper. As let's say for example your analysis is wrong, what stop loss does is it will help you minimize your loss. That is how it is. So that is just the downside. Sometimes when you see the pin bar, you just get into the market, place your entry, you flow with the trend. But sometimes there could be that at a certain level, the buyers will come and reject the price again, then push it back up bullish. That means at that point, the buyers are more than the seller. So at that point, you will not blame yourself. You did where you made your analysis was right. Your analysis is right, for you to place your entry at that point. But what dictates the market, the direction of the market, is supply and demand. Because if the buyers are more than the sellers, the price will go up. Then if the sellers are more than the buyers, the price will come down. So it is like that. So by the time you see price coming down and at the point you see a rejection, you see price going back up, that means buyers came with full force. They are now more than the sellers. That is just the story of financial market. If you understand all those things, it's very, very interesting and it's worthwhile. It's worth doing, guys. I'm telling you the truth. It's worth doing. An aggressive entry are taken at the first an aggressive entry are taken at the first signs of reversal out of support and resistance level or supply and demand level. All these things you have to watch the level where you place your entry. It's very, very important, guys. It's very, very, very important because you don't just see a pin bar anywhere, then you place your trade. No, it has to be a level, a resistance level, or support level, or use the word demand and supply. So that is how you must watch out for levels before you place your entry. Trade from levels, the level resistance level or support level. A resistance level is a level where price will get to, where price has gotten to more than twice, then it will reverse. It will come and test that level, it will reverse. So that is a resistance level. And in the same way, a support level is a level where price get to, it will reverse backward, then come again. Well, as soon as it get to that place, there's always a reversal to the opposite direction. And it has to be more than one touch before it can be valid. I've taught us before, I'm still explaining it again. Then we have three important elements to consider for an aggressive entry option. For an aggressive entry option, you have to consider some elements, which are the trend, the levels, and the signal. So the trend, the market is, when you talk about the trend, the market is clearly a downtrend or rather an uptrend. In this case, you look for selling opportunity because when you look at this point, this is a downtrend. This is a signal, it's a downtrend. So all you will be looking for here is selling opportunity. place your entry here, put your stop loss on top on top of the tail or wick. Like I told us, we can call it a tail, but the terminology in forex market, this is called wick. This tiny thing you see is a candle without body. This is what we call wick. So you place your stop loss above, little above, like maybe 2 pips or 3 pips above the tail. This is where you put your stop loss, put your entry here. Then your target point will be the next support level. So that is how it is. All you'll be looking for at this point is selling opportunity, selling opportunity, selling opportunity. So the levels. In this chart, we had a support level that becomes resistance. So this, the previous this thing, you see that the price action was going up, but when it gets to this point, there was a rejection. So here now, there was a support level. It's not acting as a resistance level now because the price is going downtrend. It's not acting as a resistance. But before, the price was going up before there was a rejection. So here was a support level. But now that there's a rejection, there's a change of character, the price, the trend is going down. This place now is now seen as a resistance level. Now you have one touch, you have another one now, then you see. But in future again, you still see price action will come to that place and retest, then it will go down again. So the signal, a clear pin bar was formed after the retracement back to the resistance level. Look at it. This is a very clear pin bar that was formed at the resistance level, not just anywhere, at the resistance level. So this is an opportunity, real opportunity. So by the time you see a pin bar at a resistance or a support level, you don't joke with it. If you want to wait, you wait for the next bear market to close, then you enter. Otherwise, get in here, or there's another strategy that will make you to wait until there's a retracement, 50% retracement, for you to double sure, for you to be double sure for more confirmation before you place your entry. Just like here, there's a rejection, you see an impulsive move. This is a retracement. This is a retracement, meaning that it has price action came back and respected this level, then it started coming down. So when it retraces the second time, you place your entry. We call it conservative entry option, conservative entry option. But as we progress, I will let us know in the next slide. So the signal is very clear because it's what? The pin bar was clearly formed at the resistance level. Now, you note, when you have these three elements in the market, you just place your trade after the close of the pin bar. Like I explained to us, we don't need to dwell on this. Once you see a pin bar at a certain level, resistance or supply, a resistance or support level, demand and supply level, you place your entry. It's very, very profitable and it's worth doing. Then your stop loss, place your stop loss above the long tail, like what I've just told us before. And here again, I'm showing us the tail. Like I told us, this tail, you can just use it as a layman way, tail, but the terminology is, we call it wick, W-I-C-K, wick. So that is how it is. You place your stop loss 2 pips price interest point. Price interest point, that is PIP. When you hear me using the word PIP, you should know by now because I've already taught us. If you're watching my video for the first time, please go and look for those videos, watch it, then you progress with us. You place your stop loss 2 or 3 pips above the wick. Then your entry here, stop your target point, like I've told you, your profit target will be the next level, the next resistance or support level. Your profit target, place your profit target at the next support level in case of downtrend, and resistance level when it is an uptrend. So it's very, very simple like that. Now, these 3 elements are quite enough for you to find high probability entry in the market. You have to consider these 3 elements: the trend, the level, and the signal, before you place an entry. Consider them. The trend must be a downtrend, or if it is an uptrend, watch out for level where there's a rejection at the support level or at the resistance level. All you need to do, your stop loss above the wick, then place your entry. Your profit target, which is a TP, target point, if you like, because those are the terminology you'll be hearing by the time you start trading. You put your TP put it at the next resistance or support level, the next support level or resistance level. That's where you place your TP. And the next one I'm going to teach you is the conservative entry option. The conservative entry option, this strategy consists of entering the market after 50% of the range bar retracement, meaning that you must patiently wait for the price action to retest the support or resistance level before you execute your trade. This is another strategy. Everybody, like I told us, you have to, test a strategy. You choose the strategy you need to, always use to navigate the forex market. Like I told us, but it is good for you to study everything about, financial market. Then you will now choose your own strategy. My strategy might be different from your strategy. It does not necessarily mean that we have to trade the same way. We can trade the same way if you choose, to follow my own pattern, follow my own strategy. But you can choose your own strategy, back test it, then you apply it anytime you want to trade. Some people prefer aggressive entry option, while some people prefer conservative entry option. Then the conservative entry option is that the rule for the conservative entry option is that you have to wait, even if there's a pin bar rejection, we have to wait again for price action to come back and retest that level in conservative entry option. But aggressive entry option, you don't have to wait. You cannot see the difference. But both, rather, if you like, they all have their, downside. They have their good side, they have their downside. So the aggressive entry, like I've told you, the downside is that sometimes price action can reverse and come back and take you out of the market. In conservative entry options, you have to wait. No, in conservative entry option, we have to wait for price action to come back and retest that same level again the second time before you place your entry. Now, the aggressive option now is that the good thing is that you get into the market early and cash the groove, and make more profit within a very short period. Why the conservative entry option, you have already missed some profit because price action will go a little, then it will retrace before you join the trend. But the thing is that is more confirmation. That is more confirmation for you to be sure that, okay, this price is either trendy, is going, this is a clear uptrend, or it's a clear downtrend. That is conservative. But aggressive is that as soon as you see that rejection at that level, support, be it support or resistance level, you know that there's a rejection, then there's bound to be a change of character. As soon as the pin bar closes, you just place your entry, you catch the groove immediately. So the downside is that price action can come and stock you out, push you out or take you out of the trend. Why the conservative aspect is that if the price reverses, you are not in the trade already. You are waiting for you are actually waiting, thinking that, okay, this price is supposed to come back and retest the level before you join before you place your order, before you make your entry, before you execute your trade. So once that happens, that, okay, for example, the price action now reverse and it start coming down, you know that, okay, you are not in the trade already. Yeah, then you will now wait for another signal before you join, before you now place your trade. That means you didn't lose anything. So that is just the good and the bad side of the two strategies. So it's like that. I hope we understand. So the conservative entry option, this strategy consists of entering the market after 50% of the range bar retracement, meaning that you must patiently wait for the price action to retest, that it will come back to that same level, support and resistance level, before you execute your trade. So it's very clear. Conservative strategy work and it gives you more than 5-to-1 risk reward ratio. That is another thing, because you are very sure at that point, you are very sure by the time the price action came back and retest, you are very sure that this is a clear uptrend or a clear downtrend. But another thing is that the downside of it is that sometimes price action does not retrace, it just move. Most especially when at that level, the bigger guys, when you say bigger guys, we are referring to um, financial body like banks, big boys and big players in the market, because those ones, they have money, even government. They do trade. They have people who trade. They have bodies who trade for them. You know, once, for example, where there's a rejection there, for example, this place now, let's say, for example, price is coming like this. Then the banks or financial institutions, they've done their analysis. They know that there will be a retracement here. So what they now do is that, what they will do is that they will place a buy stop order. They will place a buy stop order here. By the time they place a buy stop order here, what will now happen? Or here, they place a buy stop order here. Price will come as soon as they make a retracement. As it's going back, it will trigger them in. Then you see the way the price action will move with force, with speed. So at that point, there won't even be any retracement. You will just see boom, it will start going. So if you are the conservative entry guy, if that is your strategy, you might not, you might just miss the opportunity. So that is what I'm just trying to explain. That is the drawback of conservative entry option. The drawback is that price action sometimes does not retest or retrace to 50% of the range bar, which will make you feel frustrated because the market will move to the profit target without you being in the trade, like I've explained to us. It's very clear, guys. It's as simple. This thing works. Nobody will tell you, give me no. It is your own, you know, creating another source of income, no matter how little it is. When I use the word little, it depends on your financial capability. By the time you create your own account, it's your account. The amount you put in there will determine how you want to trade. $50, depending on your country currency, $50, £50, $100, $100, £100, €100, if it is €50, you use it and open your account, your own account. Then you start using that to trade. And how do you manage that? You use the word risk management. You know, risk management, like the lot sizes that I've already taught us. That is how you'll be able to, you know, manage your risk. Manage your risk, you know, based on the amount you have in there, you know. Like big guys, financial institutions, government, they use millions to trade. The, 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 the higher money you are able to trade with, the higher income you get. For example, somebody who, you know, let's say for example, somebody who, you know, used to have one branch, then the income is coming from that branch, right? You open a store or an office, the income is coming from only that place. Then after a while, you now thought of expanding. What now happens is that the person will now go, or the company will now go and, you know, open another branch. So we have two income streams now. There's another income that is coming from this branch, income coming from the other branch. So join the two together, you know, that is the income is now getting higher. So what do I mean by that? In forex, if you are trading with maybe €100 or $100 or £100, as the case may be, somebody that is trading with £100, maybe you are using a lot size of um, a nano size, you know, that you use 0.001, you know, each pip is counted in cent, for example, and somebody who is using 500 €500 or $500, £500, you know, that is able to open um, another type of account that the person can, you know, use like one lot, a standard lot, somewhere that is trading with a standard lot, mini or nano. So if you are operating on nano, the interest will be very small. Maybe where you will be making, for example, €20, the person that is using a mini lot, a mini lot size of, you know, a mini lot size, the person will be making, like, for example, $50 or €50, you know, but you'll be making €20. The person will be making 50 euro. The person that is using a standard lot might be making 100. I'm just giving you an example, an instance. The person will be making, where you'll be making 20, another person can be making 50, another person can be making 100 in each pip. There is movement of price, So it depends on the amount you put in. It depends on how you want. You can, like, if you are making 20 euro, 20 euro, 20 euro, with time, spread it with time, that is a lot of money. A lot of money. If you make 20 euro a day, for example, 20 euro a day in 5 days, that is 100 euro. This is something that you just place an entry, you go to your work. You go to your work, your traditional, you go to work. The system will do the rest for you. You don't have to, do anything, no overhead, nothing. You just do your analysis. All it takes is do your analysis, place your trade, or you place your order. But an order cannot be executed except when it gets to that level. Once you place your order, you close your system and go to work. So by the time the price actually gets to that level, it will not trigger you into the market. That is how it is. You already set your stop loss, set your target, put your order. It's like that. It's very simple. So you take it up gradually, like that. You start building, you having the little income, side income. That is how it is. Depend on your financial, your financial capacity, so to say. So it's very simple, like that. So the next thing I'm going to teach us is that trading pin bars with confluence. Confluence happens when many technical indicators generate the same signal. This trading concept is used by price action traders to filter their entry points and spot high probability signal in the market. Confluences is good to use confluences because confluences is using different type of technical indicator to determine your entry point. Like, for example, you use your Fibonacci, like I will be teaching now, use your Fibonacci tool to know where the retracement will start from. You use your what do you call it? Your moving average. You plot your moving average to see if it's acting as a dynamic or support level. So all those things, and you do your technical analysis, you plot your trend line, your horizontal line, your trend line, to really, you use all those methods, all those technical indicators to really show, okay, this is place, this is this level, at this level, okay, my indicators they've aligned and they are telling me the same story. Now, I'm very sure that I will place my entry here. So that is what we mean by confluence. I will dive deeper in the next episode. So guys, thank you very much for sticking around with me. Thank you for your support, your like. Share this video. Share it, please. Like the video. And if you have any comment, drop it at the comment section. And if you want to be part of my class, I already have students, the people that I teach. So you can email me if you want me to coach you live, one-on-one, where you can ask me questions directly. Then I put you through, I explain to you in a very simple terms, even more details. Like I have promised everyone, I will make it very simple. You see the way I'm going. I make everything simple. Instead of giving us story, at the end of the day, you might not even get nothing out of it. So I'm keeping it very simple, guys. Thank you very much. Drop comment at the comment section if you want. If you have any comment, email me if you want, one-on-one coaching from me. And hit the like button, subscribe to my YouTube channel. It's not easy to, every week bringing out these materials, free of charge. The only thing you can do is for you to just, give me thumbs up, like my videos, share it, and God bless you all. See you again in the next episode. Bye, guys.